Hi, Bilal. Welcome to the 100X show.
No, thank you very much. It's great to be on and great to be able to speak to you, Mehdi.
It's my pleasure. Bilal, to get things started, why don't you tell our audience a little bit about yourself, about Hive, and how we got to know each other?
Yeah, absolutely, for sure. Yeah, so I'm the CEO founder of Hive. So Hive is essentially an independent research company that we started in 2019, so almost 3 years ago. Kind of just a few, like 6 or 7 months before the pandemic struck. And we basically provide research we have two services. We provide research to some of the largest hedge funds in the world and the largest asset managers. And then we also have another research service where we offer a very high quality research product for retail investors. So basically trying to sort of show the type, because my background is investment bank sell side research. What's the type of research that like a top investors in the world use, and try to translate that to something that retail could use. So that's what we do. Now, just for context, my background before, Hive is that before that, I worked at JP Morgan, Deutsche Bank, and Nomura, starting in the late 1990s. So about 25 years working for these big investment banks. And I ran various research groups. So I ran, currency research, multi-asset research. I spent time in Asia where I ran research in Asia for Deutsche Bank. So I've run various research groups over the years, and mainly almost always covering investors. And then I should add, how we met, Mehdi, was that in the very early days of Hive, one of the things we have with Hive, we have a very open culture. So we have obviously the people that work, for Hive, but then also we have kind of ways for people just to get involved with Hive. And you were one of the early people involved in Hive in the very early days when we just had a blank piece of paper trying to work out what we'd do as a startup. And you were there right almost at the beginning, with your energy and your ideas. You were, if I recall correctly, you were pretty much involved in everything that we did, on the research side, marketing, business ideas. You had a huge amount of energy. And that was, I guess, 2019, 2020, I suppose, was kind of the period there. And so we had that relationship very early on in the early part of Hive, and we've stayed in touch ever since.
I learned a lot, and it was my first introduction to global macro, and I thoroughly enjoyed it. So, Bilal, to move on, I recently read your piece on markets have entered multiverse of madness. So for our audience, can you double tap on this, and what do you think? What are some of the implications of that for markets in general?
Yeah, so I'm a big movie fan, and so I'm completely up to date with all the Marvel movies. And if people watch these Marvel movies, people will know that we're in this new phase of Marvel. Since we've had the Infinity War and Endgame kind of end phase 4, we're now in the multiverse phase of Marvel. And I think there's a parallel to markets today, which is that, we had COVID in 2020, which pretty much dominated everything in markets for about a year or two, up until very recently. So we were all living in one universe, which was COVID, and all the things that were related to COVID. So it was all about, this massive health crisis. It was about lockdown, not lockdown, which countries are locking down, which ones aren't, how are different countries doing. But over the last 6-7 months, that's all kind of gone away. And as a result, we've entered multiple different universes now, where some countries, there's one universe, one multiverse, one universe within the multiverse, which still has COVID, which is China. So we've split into multiple different universes. So China, if you were to live in Shanghai or Beijing, you're still living with COVID, where there's lockdowns and non-lockdowns. So that's one universe that exists, and that has a macro implication. There's another universe, which is in Europe, where in Europe, we're facing this energy crisis. It's about natural gas, oil. There's a war in Europe. So we're kind of in this kind of weird war energy universe. Then you have the US, which is another universe, which is all about inflation. Just US has out of control inflation. Everyone is complaining about the levels of inflation, and the Fed is raising rates as a result. And then the fourth universe is the crypto universe, where crypto was this utopian alternative to the traditional, the TradFi world. And now we're starting to see that it may not necessarily be this utopia. There may also be some of the negative features we see in the traditional finance world. You're also seeing in the crypto world. And that the lesson there, in my view, is that human nature doesn't change. If you have humans in the TradFi world or humans in the crypto world, all the problems of humanity get reflected in those universes. So you have these kind of 4 different universes that we're split into right now, and they all have their interesting dynamics.
Yeah, that is true. So what do you think? Like globally, what are the implications for market? How do you go about in generally navigating the market in such scenario? I know in crypto at least, the valuate even when I was working global macro or just covering US tech, last 10 years, I would say market, not last 10 years, but last 7 to 8 years, valuations weren't the key driver. Like, let's say for US equity, US growth equities, and also recently for crypto. Now, all of a sudden, I see both on the public side and market side, at least in crypto, valuation has become very important. Investors want valuation that are sustainable or fair. So do you kind of see that also happening across the board in different economies? And how do you kind of navigate these like kind of turbulent times when you have different risks coming from different areas?
No, this is a great observation. And I think ultimately, if you kind of peel it all back, it really comes back to interest rates. So when you're in a world of very low interest rates, such as what we had since the global financial crisis, where central banks around the world, the Fed, the Bank of England, the European Central Bank, Asian central banks, everybody cut rates almost to zero. You had quantitative easing. That just pushed rates almost down to zero. And so when you have an environment where interest rates are close to zero, then that it makes it much easier for large institutions and even individuals to borrow money. And that liquidity needs to be put somewhere. And if your choice is I can put my money in cash, which gives me zero, or I can put my money into something else, which has some future return, which I'm not sure about, because my alternative is zero, I might as well put it into things where even if the returns right now in a high performing tech stock or crypto is far away, I'm willing to do that because the discount rate is so low. And so when rates are zero, it just allows all sorts of things, especially tech, to do really well, because the fundamental feature of tech is that there's often a quite large upfront cost, a fixed cost to build the software, in the case of crypto, the protocols, and you have this sort of big future payoff, often with a feature of being highly scalable. So in normal Silicon Valley tech, that's often kind of SaaS software where basically, if you get this kind of network kicker effect, then you scale massively and you become like an Amazon. And so you have this potential for these huge payoffs further down the line. And so when rates are zero, companies can fund their investments more easily because they can borrow and just fund. And investors in general don't have an alternative. So they say, okay, fine, I'll make a bet on these things. So when you're in a low rate environment, it's very helpful for things like tech and crypto. Now, the problem is when rates go up, everything changes. Now, suddenly your ability to borrow money to fund your investments suddenly is much harder. So you can't borrow money so easily to be able to fund your investments if you're a negative cash flow company. And so often the money that comes in to invest in VC and so on is itself borrowed money. So if you follow the source of the money, it almost always goes back to being borrowed somewhere along the line. So that starts to disappear. Then the other thing is now you have an alternative. Suddenly, if you can put your money into bonds, they give you 2, 3, 4%. That's not unreasonable when the alternative previously was like 1%. So for me, it all comes back to interest rates. So when you suddenly go to a higher interest rate environment, suddenly reality kicks in, and then it becomes a question of what exactly is the business model I'm investing in, and the fundamentals kick in and valuations kick in. And so for me, it's the change from low interest rates to high interest rates that changes everything. Then the question is, why are interest rates going up? And ultimately, it comes back to inflation. So we're in an inflation environment, which is suddenly much more different, that central banks have to respond to that.
Yeah, very fascinating. So, Bilal, one observation I had regarding the Depeg of whole UST and Luna, one of my thesis was that it was partially to do with hawkish Fed. Now, if you actually looked at Luna before the Depeg, Luna was twice the market cap of USD, so it was actually over collateralized. But given how the inflation prints came out and how hawkish Fed started to become, like investor flocked, and you saw like eventually the Depeg happened. There was a death spiral, and historically, I think I was seeing one of your webinar. You kind of pointed out that um, when U.S. central bank is on the hawkish side, you do see these types of Depegs happening. So can you elaborate on that? Like in that
Yeah,
chart you showed Hong Kong dollar and some
yeah,
other
absolutely.
currencies.
Yeah, absolutely. So the idea there is that there's a parallel between stablecoins and what you see in foreign exchange markets, and the idea is that if you have a currency like UST, like Terra USD, which offers an attractive level of interest, and on top of that, it has reserves in an asset that appears to be going up, like Luna, then you think, okay, that's got good backing. That can compete against the US dollar. The problem arises is that what happens when the dollar starts to offer more attractive interest rates, and suddenly the interest rate story between the two sides becomes imbalanced. Then on top of that, what happens if the fact that the US is raising interest rates makes the asset become less valuable on the other side too? And you've seen this time and time again in traditional markets. And a stark example, as you pointed out, is the 1990s. And we gave this webinar as Terra was blowing up about parallels to the 1990s, where in 1994, the Fed raised rates quite dramatically. And almost immediately, big dollar pegs started to break around the world. So at that time, the Mexican peso was pegged to the US dollar, so that it was fixed. So in theory, you should have been able to always convert your Mexican peso into dollar at certain rates. And that broke that year. It was called the tequila crisis. Then a few years later, in 1997, all the Asian pegs broke. They were all pegged to the US dollar. Before the Fed was raising rates, they were perceived to be, high growth economies. Lots of money was piling into those countries. So no one thought those pegs could be challenged. And suddenly US interest rates went up. And the world suddenly said, actually, the US looks attractive. And then the Thai baht broke, Malaysian ringgit broke, all the Asian pegs broke. Then 98, you had the Russia crisis, the dollar ruble broke. 99, the Brazilian real broke. In 2001, 2002, Argentinian peso broke. And so there's a strong parallel to that today, where if you have a fixed peg to the US dollar, whether it's a traditional FX market or whether it's a stable coin, they start to come under pressure when the other side's interest rates start to go up. And I think that's what we're seeing right now. And the Luna Terra, just because of the nature of the protocol, was such that it was the most vulnerable, because it from a market's perspective, it had a kind of a negative gamma feature, which is where when things are going up, there's kind of more buying of Luna, and when the coin's under pressure, there'd be more selling of Luna. So naturally, it's prone to this death spiral.
Yeah, it turned out the higher collateralization of Luna was actually more than 50% was speculative. So it wasn't actual people using it. It was that they had an element of speculation and reflexivity involved. So Bilal, you did mention like globally we are seeing rate hikes, or at least the expectation of rate hikes. So I wanted to explore some of the root causes of inflation that is kind of leading towards these rate hikes. Uh, what do you feel are some of the root causes globally that has led to such high inflation prints, and hence the reaction of central banks?
Yeah, I mean, for me, there's a number of different factors that are driving inflation higher. One is obviously the pandemic and COVID, and that impacted inflation in 2 or 3 different ways. Number one, it basically froze lots of industries around the world. So because people were not working in the same ways they were before, suddenly industries, especially on the manufacturing side, weren't able to operate in the same ways before. And that had this big supply chain issue where people weren't making chips before, or if they were, then the people manning the ships to be able to send them from Asia to the US, they weren't able to send them over. And even if it did arrive in the US, there weren't any truck drivers to work, and so on. So there's a supply chain issue with the world suddenly freezing. And it takes a long time to fire up the supply chain, again. The other aspect of the pandemic was that it stopped immigration and migration in lots of different countries. And so it affected the labor market in quite a profound way, where large parts of the economy are driven by immigrant workers that come in and do lots of the jobs that make economies function, and that stopped. And we're slowly starting to see that start to return, but even so, it's still not the same as before. Then you have, and these are two supply side issues. So one is supply chains got interrupted. The other is that immigration and migrant worker transfers stopped. That's both on the supply side of the economy, on how the economy functions. A third factor on the supply side was the energy sector, which even before COVID, there's been a chronic underinvestment in the global energy sort of sector. So pretty much since 2015 or so, there's been almost no really proper investment in energy. And that's partly to do, in the case of the US, that there was a shale gas boom. There was a boom in the energy sector in the early 2010s in the US, which crashed, and then that scared investors and they stopped investing. And then another part of it is this whole move towards climate change sensitivity. So countries around the world are starting to introduce regulations and restrictions that essentially tell people not to invest in the energy sector. So if you're a bank, you're much less willing, like a JP Morgan or Bank of America or HSBC, you're much less willing to lend money to energy-related companies. And so there's a lack of funding there. So what's happening in the energy sector is that they're not really investing in infrastructure to find new energy sources. Instead, they're just paying back investors with dividends. So they're just making sure the balance sheet looks good. So that's the other factor. There's a kind of a commodity shock that's happening as well. So we have supply chain issues, we have labor market issues in terms of migration, and we have energy shock. That's on the supply side. Then the thing on the demand side is, especially in the US introduced a huge fiscal stimulus, probably one of the biggest in world history, where they essentially gave checks to people directly. And that essentially led to people having higher income because of COVID, weirdly, than they had before. So people's income actually went up after the COVID-related recession compared to what they had before. So you had this huge positive demand shock at a time when the supply side was under pressure. So, demand goes up, supply goes down. Then if you go back to Economics 101, that leads to much higher prices. And we're basically seeing the fallout of all of that today, and it's lingering even to this day. So those are the main factors, I think, that have driven inflation higher.
Bilal, that was great color on how inflation is unfolding globally. So Bilal, I'm seeing very high inflation in some of the Western economies, double digit in UK, high single digit in US. Kind of reminds me of Pakistan, which has been battling these type of inflationary pressures. So do you think after some of the central banks in these Western economies, if they start hiking the rate, do you think we'll enter a stagflationary environment, or do you think there will be like a brief period of a demand side recession? So with this question, I'm trying to basically ask you whether inflation, do you think, will be transitory, medium run, or do you think it will be kind of long run, and it will and we are kind of walking down a treacherous path?
Well, I think we definitely are walking down a very treacherous path. And in terms of just definitions here of stagflation, my sense on inflation is we're seeing these 9-10% inflation rates in the Western economies right now, similar to what Pakistan and other countries have experienced in the past. And what's interesting now is the language the Western policymakers use when they have high inflation compared to the language they use when they criticize countries like Pakistan when they have inflation is very different. Suddenly it's all like, oh, it's because of this or that reason. Whereas when it's in poor countries, it's always because, poor countries don't have the right institutions or the right people. But it's the same thing's happening in the West as well. But the point I would make here is that inflation is very high right now, 9-10% or so. And my sense is it will fall. I mean, we're in the phase now where we've hit peak inflation. So inflation will fall in the next 6 to 12 months. So in that sense, inflation, is falling, is likely to fall in the next 6 to 12 months. And almost everyone agrees with this. So in that sense, we're still in an inflation environment, but it's different from, say, 6-7 months ago, where we had high inflation and rising inflation. Now we have falling inflation, but still high inflation. So the flavor of the inflation background is a bit different. It's still inflationary in my view, but the flavor is different. It's falling. And that's one of the reasons why the market is behaving a bit differently now, because, when inflation is falling, even if inflation is high, the market is more likely to think that, okay, problem solved with inflation, and it tries to fade what the Fed was likely to do. So, but in my view, even though it's falling, it's still high. So for me, it's still an inflation environment. Then on the growth side, I do think we're in recession territory. I think that it's very likely that the US and other Western economies will be in a proper recession by early next year. Now, we have a model where we look at interest rate curves in the US, what's called the yield curve, where you look at the 10-year interest rate and you minus it from the 2-year interest rate. And what you typically find is when the curve inverts, so when shorter term interest rates are higher than longer term interest rate, that often tells you you're going to have a recession quite soon. So we've built a model that gives you a probability of that. And right now, it's giving you a probability of 40 to 50% of a recession in the next 12 months. And we publish this on the Macro Hive site. So you can just go there and you can see we publish it every week and you can see the probability. Now, my sense is the probability should perhaps be even higher than that. And the reason I think that we're in this environment, so this, in my view, could be classified as stagflation, because inflation still is high and growth is weakening. And one of the reasons why you will have this recession is that the Fed, will really have to do a lot of demand destruction to bring inflation down, because the supply side of the economy has deteriorated. So if there's less supply in the economy, then you not only have to reduce demand a bit, you have to reduce it a lot, because supply is also reducing. And so this is what you found in the US when they had stagflation in the late 1970s, early 1980s. They initially thought that they could just raise rates a bit and that will be enough. But very quickly, they realized actually you have to tip the economy into a recession, because the supply side's already constrained, to really bring demand down to meet where supply is right now. So I think that's the environment we're in. It's a very sort of difficult and challenging environment, but that's the environment we're in right now.
Absolutely, Bilal. Kind of feels like a proper regime change in terms of how macro outlook looks like. Like last few years, we saw a SPAC boom, we saw crypto boom, and all of these high beta plays. So now I'll be interested, again, not financial advice, how should investors play this? Like how do they allocate, perhaps in the short run, medium run? I will define medium run as, let's say, next 2 years, and perhaps the long run. Like, how do you kind of navigate this type of regime change?
Well, first of all, it's very, very difficult. And, I speak to some of the top investors in the world, hedge funds and so on, and all of them are finding it really, really hard right now. None of them are finding it easy. So, so if you're an individual investor trading markets and you're worried about your portfolio, you're not alone in doing that. My general word, my general thoughts in this type of environment is, and this is, having been around for a while in markets and studied successful investors. Investors, for me, a successful investor is somebody who can sustainably increase their wealth over like 10, 20, 30 years. So there are some investors who make huge amounts of money like for 1 or 2 years, and then that's it. They don't, either they lose half of it or they can't, keep making that. But for me, that's not really success. That's almost like luck. You just happen to buy the right asset at the right time, and then that was like a one-off. For me, what I care about is how do you sustainably maintain your wealth so that you can, retire with a nice nest egg, nice retirement, with that money. And the key thing when you study investors like that, and my own experience, is that the key thing is first of all, don't get wiped out. It's called the risk of ruin. And Nassim Taleb talks a lot about this in his books as well, is the key thing is you shouldn't have positions on which can potentially wipe out a lot of your wealth. That's a really dangerous position to be in, because if you have, say, $100 and that goes down to $10, no matter like what returns you can get, even if you can get 20, 30% returns, if you're starting from $10, it's really hard to grow it back to where you were before. Now, if your $100 move down to $90 and then you make those 10, 20, 30% returns a year, it's much easier to start to compound back up. So my first kind of advice with investors in general is that don't have your positions structured in a way where it's easy for you to suddenly lose half your wealth. And that's especially important when the markets are going through a regime change. Because when you go through a regime change, weird stuff happens. You get up days of 10%, then down days of 20%. Markets become so unstable because you go from a low rates environment to a high rates environment. That's a regime change, and the system starts to crack and break. And it's not just the returns of the market, but platforms as well. Suddenly you're trading on a platform. The platform you think you can execute, but suddenly liquidity dries up and your order doesn't go through, or the platform breaks down. All these sorts of things start to happen when you're going through regime changes. So the first thing is make sure your position sizing and your leverage is such that you don't get wiped out. In general, my sense is in an unstable environment like we're in today, like a 2022 environment, I would actually skew to holding a lot of cash. So if you have a portfolio and you have to be long something, I'd be long cash. And that's kind of a very defensive sort of position to be in. But the advantage is that cash won't get you wiped out. And it then gives you the optionality to buy markets when they go down a lot. So you have the liquidity, the ability to use that cash to then buy the market when it's down another 20%. So, on the Macro Hive side, we have like this asset allocation, a report that comes out once a month where we tell people this is how you should bigger picture structure your wealth. And we've been saying for a long time now that you should overweight cash. Now, if you can short markets, that's also an opportunity. You could short some risky markets, but there's some risk associated with that. But I think in general, the key thing in a year like this is not to get wiped out. Probably have a bit more cash than you would normally have, and be patient. Don't be a hero and just be patient, because I don't know exactly what's going to happen. Top hedge funds in the world don't know really what's going to happen, and so it's not an easy environment to be in right now.
Well, that's a great advice. Just to kind of give you an anecdotal evidence, like why I actually got into crypto was during pandemic, when the market were crashing, and then all of a sudden we saw a Fed put. I wanted to buy some Nasdaq stock, and I remember when I came to Pakistan, like Interactive Broker just wouldn't let me open a brokerage account because there were just too many applicants trying to open account. Even though they later gave me the account, but during that time, because of whatever reason, because maybe I'm from high risk country, they just wouldn't let me open the account. So when I actually in DeFi summer 2020, like when the DeFi summer happened, I saw some of the projects like Synthetics and Mirror, where you can have exposure to synthetic stocks just through Oracle. Like that was for me like a moment where I was like, platform risk is real, and middlemen sometimes can be can also be a risk. So that was my kind of like a first aha moment that, okay, you know what, crypto is the future. So now using that as a segue, I want to take your take on crypto markets. I know you have different models, either based on chain and recently also launched stablecoin TrackWatch. So what are you seeing in crypto markets?
Yeah, no, I think you make a really good point about some of the advantages of crypto. And right now, all the crypto bears are coming out and saying, we told you so, crypto is terrible and so on. And, I'm not one of those. My kind of take on crypto is to be very balanced and objective. It's a new technology. When new technologies come out, markets often go very wild and crazy. And they often have crashes, but if their technology is real, it ends up staying with you. So like the internet is an example where stock valuations went crazy in the 1990s. Then you had the massive dot-com crash. And then for like 10 years, tech stocks did nothing. But here we are. Internet's still with us. It has changed the world. It's a critical technology. And I think that, there's something similar in crypto as well. So I kind of, first of all, just say that from the outset that, even though the price has fallen, it's not clear that means that it's the end of crypto. On top of that, because the correlation of crypto is so high to normal equities, if you use the argument that the price of crypto has fallen, which means that you should never hold crypto, you should then, it follows from that you should never hold equities either, because equities have crashed as well. But people have this dissonance where they think, okay, I'll still hold equities but not crypto. So that's the first thing I just want to kind of add to provide some kind of support for crypto. Now, in terms of the metrics we look at, perhaps I can share the screen if that's possible.
Yes.
So I'll just
Go
hit share. Let me see. Does that work? Let me just share the screen. Okay, cool. So this is the sort of Macro Hive website. So you can see, hopefully you see the boxes. That's our latest note. So this note here, just for fun, is Torsten Wegener is a real expert on trading equity derivatives. He used to run some trading desks at some banks, and now he educates people on using options to trade markets. And he over here, he gives some thoughts on how you trade markets when you have large 1-day drops or 2-day drops. Should you fade or should you buy them? So that's what that piece is on, in case people are wondering what that is. But if I just go to our crypto work, so here this comes out every week, and we basically have a dashboard that gives you bullish bearish signals on Bitcoin or on Ethereum. So in this case, this piece we were focusing on Bitcoin, but we have a number of different ways of looking at Bitcoin fundamentals. I mean, the challenge, with Bitcoin is that because or any crypto, is because it's not like a normal equity or like a bond, you have to analyze it slightly differently. And but there is a framework. You can have a framework to look at crypto, and that should give confidence to investors. Whereas some people think that there's no framework. It's just you just have to guess. But there's things you can look at that gives you a sense of whether we're in a bullish or bearish environment for Bitcoin, say. So looking at Bitcoin, which for me is like the benchmark for crypto. So if Bitcoin goes up, then generally that's bullish for the rest of crypto. But Bitcoin goes down, it's really sort of bearish. That's the starting point. But the things we look at are, so this is flows into ETFs. So this gives you a sense of institutional demand. As we know, 1 or 2 years ago, there was a big institutional flow into crypto, which really helped the market. Recently there was some buying of as Bitcoin was falling from 40 down to 30. ETF flows actually picked up into Bitcoin, so people were buying into the weakness. But now that's turned into selling, so that's kind of more bearish now. So it looks like even though we've been in this range around 30,000 for the past 4 or 5 weeks, over the last week or so, people are getting nervous now. And they, on the ETF side, so kind of more institutional type people are starting to sell, which is bad. Then the other thing we look at is crypto exchanges. So like Binance and all Kraken and all these sorts of guys. We look at flows into and out of these exchanges. What balances people are holding at the exchanges. So if it's orange, that means their flows are leaving the exchanges. That means people are moving money from an exchange into their wallets, private wallets, which is actually a bullish signal, because that means people don't want to have liquidity to sell the Bitcoin. Recently, though, over the last week, people are moving Bitcoin from their private wallets onto the exchange. So this is early days, but that often is a bearish signal for Bitcoin, because that probably means that they're moving it onto an exchange in order to sell. So we're monitoring this quite closely. We look at futures activity, which I'll leave for now. Then the other one we look at is something called revived supply. So what we look at is coins that have been out of circulation for 1 year or more. Are they coming back? So this is using on-chain. Are they coming back into circulation? So this often means that somebody had a coin in their wallet, they've held it like 2-3 years ago. They haven't traded that, and now suddenly they trade that. So it comes back into circulation in the market. And recently, the orange line, that's really started to pick up. So that's quite a negative signal. That means people who've been kind of holding Bitcoin for a while now are suddenly bringing it back into the market. Then we look at hodlers. So, we look at the hodlers, what share of the crypto market is sort of dominated by long-term hodlers, like 1 year plus type people, versus 1 year less than 1 year. The interesting thing here is that what we found is that the people you should watch are kind of new people, like new hodlers, people who've held the coin for less than a year. When those types of people start to become a bigger share of the crypto market, that's a bullish signal. So often when you look at commentary, people look at like the long-term hodlers, but there's actually the newcomers that are kind of driving the marginal sort of demand. And so, for example, here you can see that in the middle of 2020, suddenly you started to see all of these people who have held Bitcoin for less than a year. Suddenly, that share of the market started to increase, and that coincided with the surge in Bitcoin, up towards the 60,000 mark. Now, recently, all those guys, that segment of the market has been sort of selling, or they're a smaller proportion of the overall market. So I'll be watching that to see when are kind of these newbies coming back in, and that will be a point of stability. So again, this is kind of a one way of looking at flow in crypto markets. But overall, our sense of the on-chain, the flow is that it's kind of generally giving you a bearish signal. Not super bearish, but like it's leaning that way. But the issue, in general, is on-chain is important to some extent, but there's a larger beta to risk markets. I mean, the correlation between Bitcoin and equities is super high, 80-90%. So to some extent, what matters more is where is tech stocks going, and that will give you a bigger signal of where Bitcoin will go. And then the remaining 10-20% of the correlation that can't be explained is probably driven by these on-chain stuff.
So Bilal, yesterday I was reading one of the articles regarding stablecoins, regarding US Tether. So one graph that stood out was traditional finance is now giving more yield, like higher yield, US money market and some of the futures contract in Depeg currencies, than let's say on our way, some of the stablecoins such as DAI, US Tether and USDC. So maybe perhaps also share that chart.
Yeah, absolutely. Yeah. I mean, again, because we straddle both sides, we look at crypto and traditional markets, we can kind of look at things holistically. And so one of the things we were doing was that a lot of people in the crypto world put their money into stable coins, like the safe stable coins, like
can you just zoom in a little bit?
Sure. Yeah. So what we're kind of looking at is what's the yield you can earn in crypto, in the safe crypto stable coins versus regular fiat markets. And so, for example, USDT, so Tether, and this is on compound, gives you a 2% yield if you hold stable coin on a solid sort of platform. USDC, which is dollar coin, which has really high quality collateral, is audited by proper auditors and all the rest of it. That gives you like 0.9% yield if you're like depositing or lending into those stable coins. If you're on Binance, you get 1.4%, and then and that's on the Aave platform. And then DAI gives you 1.4%. So kind of the range is for kind of the solid stable coins that have good collateral, that type of stuff. You get kind of 0.9 to 2%, and then your market risk is to the dollar. So you're assuming the peg holds, you're basically long dollars with this level of yield. So what we did was, we said, let's look at other dollar markets and fiat markets, traditional markets, and see what yield you can get there. So if you put your money into treasury bills, which is the safest thing you can do, you get 1.1% yield. So it's higher than dollar coin. If you put your money into commercial paper, let's say the lower rated one, the 80, you get 1.7%, which is more than Binance and DAI. And then what we looked at is currency peg. So there's like stable coin is a coin that's linked to the dollar. Let's look at currencies linked to the dollar. The Hong Kong dollar is linked to the US dollar. So if you're putting money into a Hong Kong dollar deposit, the yield you get on that is effectively a dollar yield because Hong Kong dollar shouldn't move versus the peg. There you get between 0.4 and 0.9% yield. Saudi Riyal, so the Saudi Riyal is pegged to the dollar as well. So if you put your money into a Saudi deposit, you earn between 2.2 to 2.9%. And the currency risk there is the peg. Will the Saudi peg go or not? Unlikely, because they have massive reserves and then an oil producer. So what you're finding is that traditional markets now are offering you yield that is in the same ballpark as the safer stablecoins. A year ago, Tether, USDC were giving you 10% yields. Today, the yields have gone down for various different reasons. And so for me, that's also a kind of a point of caution around looking at stablecoins as a way to earn yield. And And so, yeah.
Yeah. If you go on different platforms, right, like platform which are more centralized, like let's say Nexo, they'll give you higher yield because you have a platform risk in between. Whereas in
Yeah.
Compound, you can kind of assume it's decentralized. So again, very interesting development there. Yeah, so you did touch upon like some of the crypto projects. Like I feel like they are like a hybrid of equities, digital commodities like digital oil, and also currency. It's like a mix of these three, and then you have different layers. One of the things I just wanted to discuss, like you have this thesis on markets are entering into a multiverse. I feel crypto is also a multiverse. You have like different verticals, and then within those different verticals, you have different tokenomics that makes either crypto more inclined towards equity or a digital commodity or perhaps a currency. So just wanted to like discuss your views on perhaps each of the verticals. Like how do you kind of see it happening? How do you kind of see it evolving? What are some of the segments you're bullish on? Let's just
Yeah, absolutely. Yeah. I mean, obviously, there's so many different crypto projects that it's hard to do it full justice. But in general, I would say there's like four or five, sort of overarching kind of, multiverses or themes. What one is the starting point for me is always Bitcoin, because that's a very long track record that gives you some level of confidence, and that in some ways is the sort of the benchmark or or like digital gold or store of value. So that's kind of one category is just Bitcoin itself. And what's interesting about Bitcoin for me is that, unlike say Ethereum and other sort of protocols, even it barely changes. There's like no kind of moves to move from proof of work to proof of stake and so on. So in some ways that's quite good because it tells you that if it's lasted this long without changing, it probably can last long as well, because it won't be disrupted by something else. People find it attractive. That's something that doesn't change its protocols all the time. They still want to invest in. So that's kind of one category. And for me, that's in some ways the sort of the safest crypto to be in because it's got a long track record. It doesn't change that much the protocols. So that tells you that people value that. And in some way, from a philosophical perspective, people who don't trust the traditional finance system, the use case for Bitcoin is this is an alternative to that, and it's stable in terms of the protocol. So that's one sort of category. Then you have the kind of the smart contract type coins. Obviously, Ethereum is the biggest, but then there's Cardano, Solana, Avalanche, and so on. There's a whole load of them. And they all have their pros and cons. Some are faster than others. Some have a bigger ecosystem already, like Ethereum. Ethereum's, at some point going to switch from proof of work to proof of stake, which would reduce the transaction cost of using that platform. And it's hard to say right now which one's going to win out. Obviously, Ethereum's the winner right now, but maybe Solana will be, or maybe Avalanche will be, or maybe something else, will sort of come up. So I think there's this uncertainty around what is the smart contract layer, the L1, that's going to be the winner there. And my sense is that you probably want to kind of have exposure to each one of those, because it just right now it's hard to know which one's going to be kind of the winner. So that, and I think some version of a L1 or some combination of L1 will be around with us, for the future. So there is some legs to that all. Then you have the whole DeFi side, which is all about trading, decentralized exchanges, earning higher yield, tokenomics, and all of those sorts of things. For me, that's at a point of vulnerability right now, because that works very well when you're in a bullish market, because in a bullish market, people will want to go into new tokens that will go up in value, and decentralized exchanges can issue new tokens into a bullish market without the token falling in value, which can then allow them to offer higher yields, and you get all these platform effects and more people come in to trade, and you get all these trading sort of dynamics. So I think that's in a point of vulnerability. The other issue for DeFi is regulation as well. That's probably the biggest target from regulators, because that's the closest to traditional finance in the sense that it's providing an alternative to banks. And if we're in an environment where crypto is weakening and coins are blowing up, you're going to get someone sort of saying, look, I lost all my money in some DeFi token, and it should be regulated. So that for me is a big point of vulnerability. So for me, I think DeFi is in this kind of transition point. And there's a lot of kind of growing up that will have to be done. Then you have the metaverse stuff, which and Web3 and all of that. I mean, that is such a loose and open contact. It's hard to get your head around that all. I think there is something about this in the long run. Obviously, you get the traditional companies like Facebook and Meta and Google. All these guys are coming to this space as well. And everyone says they're Metaverse now or Web3, and it's hard to know exactly what those terms mean. But more specifically, as far as I can tell, the more popular versions within crypto of Metaverse type tokens generally revolve around virtual land. So basically, you create some kind of a land with scarcity and you attract people to that land. So it's Gala and things like that. And then the other one is the gaming, on the gaming side, where you earn as you play the game. For me, this side, the metaverse stuff, I think is very vulnerable in an environment where you're not in a bull market, because these are really kind of forward-thinking type markets where there's a lot of potential, like somewhere far, far in the future, but not right now. And I think they're very sort of vulnerable right now.
I echo a similar sentiment. Even though I'm very bullish on games and metaverse in the long run, I feel like literally all of these metaverse and gaming side of things can literally operate as economies, like not even protocols, like economies where you have users owning things, like owning their identity avatars as NFTs, renting them out, and so on and so forth. But it's kind of like a distant version. So similar to you, so I share a similar view. I feel L1s are like a multi-sided platform and gives investor index level exposure to DeFi casino, to Web3, to metaverse gaming, all of that. So at the end of the day, the value does accrue to layer one. And there is a very beautiful article written 2-3 years ago called Fat Protocol Thesis, where every like all of these things accrue value basically to L1s. So again, like at the moment, even my portfolio and some of the things I'll be looking to buy will be around layer ones, because I feel they could be the next FANG, because the multi-sided platform nature of these means strong flywheels and like stronger flexibility. So going on to that point, like as I shared that I'm very bullish on layer ones for the longer horizon. Vlad, do you own any crypto in your portfolio? And if so, how are you allocated?
Yeah, I do hold crypto. So I have essentially Bitcoin and a range of L1s. So the L1s I have are just the bigger ones. So Ethereum, Solano, Cardano, which are the ones? Avalanche, and yeah, I think those are the main ones I have. The allocation is relatively small, because I think we're in a very defensive environment right now. I hold some of them on centralized exchange. I hold some of them on a decentralized exchange, and I hold some of them in the Bitcoin I hold in a cold wallet, which is kind of the ultimate kind of apocalypse trade, so kind of on a little stick.
So Bilal, do you kind of see Bitcoin by getting de-correlated with some of the L1s? Like the way I see market is you have Bitcoin, which is kind of similar to digital gold. Then you have L1s, which is similar to US, like established US equities. And then you have all of these venture bets. Do you think eventually we'll have this bifurcation, at least from the Bitcoin of all of these projects? Like, do you think that will eventually happen? Or do you still think there will be correlation with Bitcoin and also US equities?
No, absolutely. I do think there will, start to be some decorrelation. I mean, obviously, right now it's hard to see that because everything's correlating. Not just within crypto, but across all risk markets. But as time goes on, I think you're right. I think there will be this bigger bifurcation. Often when you have new markets, illiquid markets, I mean, everything starts to kind of look the same. But I think you're right. I think Bitcoin is almost kind of separate from the other ones, and its volatility will start to fall over time as well. And as you say, L1s are kind of like the foundation layer of everything else, and there'll be kind of a battle to see which ones. And then there's all the apps on top of that all. So I think you can kind of split them all up in that way. I think I think that there is some interesting sort of dynamics on top of all of this, which are that there is a response from the traditional finance world as well, on this. So for example, you have central banks talking about their own digital currency, and so it's on the blockchain, but it's centralized, which kind of goes against the ethos of crypto. So it'll be interesting to see how that dynamic sort of pans out. Then also there's other things like the Fed is introducing real-time payment settlement next year versus like 1 or 2 days right now. So one of the beauties of crypto is often you get instantaneous transfers or like a couple of minutes or whatever. Now the traditional systems are fighting back to have that same capability as well. So that kind of introduces a quirk in terms of, will that affect Bitcoin? Will it affect some of the use cases for some of the other coins or not? So there are some uncertainties there, but in general, I'd kind of agree with how you sort of characterized it.
Bilal, actually, I'm very bullish on centralized exchanges. I feel all the DeFi and everything will become the back end, and I think we need exchanges to become the front end. I personally feel in next few years they'll become next Amazon earlier than some of the L1s, because if you see some of the trends, right, they have end-to-end like horizontal as well as vertical integration. So them being early stage investor to NFT marketplaces to providing liquidity and market making, like it's strong at the moment. Like I don't feel crypto for next few years will be ready to just kind of disrupt centralized exchanges. Even if they do, it will be more on the back end rather than the front end. Yeah. So Bilal, before we conclude, I know you said cash is sort of like a king and survival is important. Do you have any investor tip that you believe could help our audience kind of navigate current turbulent times? Like some of the tips that are kind of close to you, you kind of revert back in times of crisis or in times of
I mean, I think there's a few things. I mean, the first thing which people don't talk enough about is the way we emotionally respond to our P&L. That's very, very important, because if you don't manage your emotions well, then it doesn't matter what the advice I give you is, because you're going to end up doing crazy things. And so a key thing is to separate your emotional state from your P&L. So, I mean, the ideal, although this is impossible, is that if you have a big down day, say you've lost 10% on your coins, for that not to destroy your day emotionally, where basically you become grumpy and angry and you can't sleep anymore. So managing, your mental relationship to your P&L is very, very important. And some of the most successful investors in the world, what I find amazing, remarkable about them is how they cope with losses. So when they're experiencing losses, while obviously they have a negative emotional response, it doesn't destroy them, as thinking. So first of all, I would sort of say that doing things to help you manage that is very important. So one technique is, not to view P&L as your self-worth. Instead, have other reference points for your self-worth. Like, for example, you could see your self-worth linked to the fact that you're kind to other people or something like that, or that you're very diligent in reading or something. Just link your personal self-worth to something else, but not the P&L. So that's kind of the first thing. The second thing is, I think it's useful to have some kind of system or framework when you're investing in markets, especially difficult markets. So, for example, if you use charts a lot, be aware that you're using charts, and so use the system when the market is not moving in the way that you think. Go back to your system and say, okay, what does my charts tell me about what to do, and use that as a basis of what you should do next. Or it could be fundamental analysis, because often what can happen is, especially when you're making big gains or big losses, you suddenly throw out your framework, and instead a classic thing is FOMO trading, where you have a system. Suddenly you hear a friend of yours has just bought into some random token that's gone up 100%, and you ditch your framework and you buy that token because your friend has done it. That type of stuff just isn't kind of very, very, very good in the long run for one to have. Then the other thing, as I said earlier, was that in a very unstable regime like we're in right now, it's better to be on the defensive side. So more cash, In the crypto world, probably lean more towards Bitcoin than some of the altcoins, lean more towards some of the safer stable coins than some of the high yielding stable coins, kind of just always go more towards the defensive side of everything. And recognize that, things will be different in 6 months time or 3 months time, and be prepared for that. And then the other thing I would say is that sometimes when you have really unstable markets, it can often lead you to kind of become quite frenetic with your decision making. You think, what should I do? What should I do? But ultimately, there's only really 3 things you can do. You can either sell whatever you have, you can either buy something, or you can either do nothing. And so when you reduce it to that, it just helps clarify, this kind of decision paralysis that you could have, where you could say, okay, like whatever's going on, the only thing I need to decide right now is, should I buy, should I hold, or should I sell? And then sometimes when you reduce it to what is the decision you have to make, it just makes things a bit easier for you to take the next step.
Yes, Bilal, those are some great advice. I had great time speaking to you, Bilal. Again, thank you for coming to the 100x show. I had a great time.
Great. Likewise, yeah. It's great speaking to you as always, and keep up the good work, Mehdi. And it's some great stuff you're doing there.